Alright, today is Sunday, October 11th, and this is a post-market review for the stock market activities on Friday, plus an outlook for this upcoming week's activities. You see the agenda of the day, interesting subjects across the board, but we also have charts of the SPY, the Qs, the VIX, the dollar index, and this time around we will cover the IWM, Apple, and Tesla. And of course, hang around for the conclusion of the video because we will dissect the market's mixed messages from this week's action regarding the upcoming elections in the US. I will tell you what I think and how the market will behave, in my opinion, in the next few weeks. And here we go, the Dow Industrial Average closing in the green, 161.39 points, or a gain of 0.57%. The Nasdaq leading the day with 158.96 points. Let's make that 159, or a gain of 1.40%. The S&P 500 in the green, 36.31 points, or a gain of 0.88%. What about the sector's performance for the day? Technology coming from behind and taking the gold medal. Basic materials taking the silver, and consumer cyclicals for the bronze. The laggards of the day, energy, real estate, and utilities. As you can see, Friday was a risk-on kind of day compared to the rest of the week. Speaking of the rest of the week, let's check out the weekly closing for the market sectors. Leading the pack, technology coming from behind. And when we cover the heat map analysis, you will realize that it was not big tech that was responsible for the surge on Friday. But back to the weekly performance. Energy, massive gains for the sector this week. And of course, healthcare, due to the prospects of a Biden's win. We will talk about that a little more in the conclusion of the video, but for now, moving on to the futures market review. As you can see, metals outperforming across the board in the green due to the huge decline in the US dollar on Friday. What about meats? Lean hogs a little muted, but massive gains throughout the week and the recent period. Matter of fact, here is the chart comparing the gains of lean hogs versus the technology sector since September. As you can see, lean hogs outperforming technology significantly with over 40% gains. The pigs are outtaking tech. What about grains? We see a little pain here for rough rice, but soy products continue to surge higher in terms of prices. What about softs? OJ and coffee outperforming, however lumber and coca lagging for the day, and they've been trending lower for a while now after a significant rally earlier during the summer. Moving on to cover the options market, aka the big casino. Right away, Apple at number one, the hottest table in the world, with 1.6 million contracts traded on Friday. 74% of those were calls. Tesla, per usual, at number two, with 800,000 contracts traded. 58.5% of those were calls. And the third place goes to AMD with 620,000 contracts. 67% of those were calls. And here is the most active trades for the day on Friday. You see a lot of gambling in terms of General Electric, GE. We'll ignore that. The stock has been dead for years now. But the most notable action is for Apple, the 120 call, leading the day, and these of course expiring this upcoming week. Here is a confession. I was at the tables playing and buying Apple 120 calls following the herd. As I explained to you in this tweet, the zombies will stampede buying Apple shares in anticipation of the event where Apple will reveal the new iPhone 12. All we have to do, buy the 120 call, and I did that on Friday morning as the tweet suggests. And of course, I don't intend on holding this for long term. I will probably close it on Monday or Tuesday right after the event. And I do buy Apple calls periodically as a hedge against my short position in Apple. But again, you see the optimism in Apple shares when you look at the change of open interest. The increase here goes to Apple 140 call expiring in 2021. Yet of course, when you look at the decrease of the open interest, you see that the Apple 150 expiring November is being closed. So you see optimism in the very near term by buying the 120 calls expiring next week, and in the medium term, less optimism by closing the 150 call expiring November, yet again betting on a rebound and that Apple will trade at the 140 level in the upcoming year. Of course, you have to understand that Apple has turned into a casino, and you should take these trades with a grain of salt. But here is an interesting trade, another one for CVS, closing the 62.5 calls, expiring this upcoming week. We have, of course, earnings from Walgreens this week, and it will have implications on the shares of CVS. So perhaps not very optimistic on pharmacies here. Now, let's check on some interesting trades that took place on Friday. Right away, you see the Xilinx 135 call expiring this upcoming week. Of course, this is due to the talks that AMD will buy Xilinx. Now, if you do remember, on Wednesday, there was an interesting trade that we covered. I did not talk about it, but it was right there on the screen. Buying the AMD 92 calls expiring this upcoming week. Somebody knew something about the news from AMD acquiring Xilinx. However, they bet the wrong way. They thought that AMD shares will act the same way Nvidia shares acted upon the news that AMD will acquire ARM. And of course, this is why we watch and analyze the options market every day. Here was another trade we found out on Friday, buying the 465 puts on Zoom, expiring this upcoming week. Now, you might have noticed that Zoom underperformed this week. I don't see this trade as a bearish trade against Zoom. I see somebody selling these puts, betting that Zoom will catch up and rally this upcoming week. I will talk more about that when we talk about the rotation trade. Now, let's take a look at the heat map analysis from a daily perspective. Right away, you see on Friday the big tech outperformed, while sectors like energy and even the chips within technology underperformed. Now let's shift to the weekly look of the heat map, and it is exactly the opposite picture. You see energy outperforming, you see chips outperforming, utilities outperforming, while big tech and Tesla underperforming. Now, what does that tell you? It tells me, at least, that the theme we've seen throughout the week of weaker sectors such as energy outperforming is coming to a halt, and you will see big tech outperforming continuing on the tune of Friday this upcoming week. And here we go. Moving to the rotation trade from a weekly perspective, huge gains across the board, but you see a slight outperformance by the comeback, aka reopening stocks. Now, look at the contrast between Peloton and Zoom. Peloton outperforming Zoom significantly. These two names used to trade together, not anymore. Peloton up big, and I expect Peloton to start declining next week due to activities I have seen in the options market, even though Peloton had a massive day on Friday. But I do think that Peloton is pulling a draft king on me. I'm not gonna fall in that trap again. Meanwhile, Zoom Video, which underperformed this week, I believe that it will overperform this upcoming week. A decline in Peloton, again in Zoom. This is the way I see it. And of course, you see Netflix, Amazon outperforming the rest of big tech. It could be some funny activities for Masa-san buying more calls on these names. But again, you see how big tech managed to catch up on Friday. Friday was a significant day for big technology companies, and they managed to close the gap with the lagging sectors. Speaking of, here we go. You see very tame gains in the airlines, at least the one I have, Southwest up 2%. Impressive gains. However, when you compare it with the rest of the names, not so impressive. And of course, that is due to the stimulus fiasco back and forth that we will cover in a little bit. But you see names like Marriott, Emerson, Cisco, Royal Caribbean, GM outperforming. And look at the gains in the beer sector, specifically here, Budweiser. Unbelievable. Up 10% this week alone.
Yes, we drank beer. I liked beer. Still like beer.
We did see a big rotation towards small caps and lagging sectors, aka value, during this week, and I will show you that in details in the conclusion of the video because it is related to the outcome of the elections, and the market is sending a clear message here, so stay tuned for the conclusion. But for now, we're covering the headlines that shaped the day, and of course it is all about the stimulus fiasco and the back and forth talking about the stimulus deal, dragging the outcome and the uncertainty further and further every day. The market became frustrated and decided to look at the tea leaves and made its own conclusion. Whether that is right or wrong, we will see. But for now, let's follow the sequence of events regarding the stimulus. Right away as the day started, we heard from Propaganda Minister Larry Kudlow, who by the way made it sound as if both sides agreed to a stimulus deal. And you saw futures, or rather the stock market, it was trading at that time, surging higher. But of course, the propaganda minister never tells the truth, and we found out that he was talking actually about Trump upping his offer from 1.6 trillion to 1.8 trillion to meet Nancy halfway. However, Trump is now battling two sides. He has a fight with Nancy in one hand, and now he has a fight with his own party, the GOP, on the other hand, because we've heard from Mitch McConnell, and this is very important, saying that there is no time to pass a stimulus deal right now before the elections, and the differences are too big to do so anyways. Right after that statement, you saw technology stocks started to outperform, while the Dow Jones and the SPY, the S&P 500, came off the highs. That of course reflects the market's confusion. Right now, the market is all over the place, moving along with the headlines. And when they heard Mitch McConnell's statement, the market started to revert back to the old yo-yo game of shifting from the reopening names to the momentum names / stay-at-home names / technology. And it's very confusing for traders, and I will try to make that as clear as I can during the conclusion of the video. And of course, as the day progressed, we started seeing that division between Trump and the GOP becoming clearer. We heard news that the 1.8 trillion proposal has no support or enough support within GOP senators. Republican senators themselves oppose the 1.8, and they think the 1.6 was too much to begin with. These are people who are also worried about their own asses in their own elections, because the Republican Party is supposed to be the fiscally conservative party. And if these senators pass a bill of 1.8 trillion in spending, they will have to face their constituencies who expect them to be fiscally conservative. And right away, you figure out that the president is very desperate, and this is a sinking ship. These are Republican members saying that. They're saying that it is a sinking ship, and the president has become very desperate, and he is on a trial of self-destruction right now. The president, right after he came out of the hospital, has become extremely erratic and all over the place, making very bad decisions, saying that he's withdrawing from the talks about stimulus, and 7 hours later, coming out publicly begging Nancy to come back to the table. Very bad look, losing look for the president. And of course, right away you see Trump came out and said, hey, I'm willing to go even more and higher than what the Democrats are willing to offer. I'm willing to spend more than 2.2 trillion. How about we go 2.5 trillion? How about 3 trillion? How about 5 trillion? Let's go. Let's go big. That's what he actually tweeted. But it is too late, and the president dug his own grave. He fell into Nancy's trap. And now you see that the rats are jumping the ship. Here we go. Ted Cruz of Texas warning of a bloodbath in the elections regarding the GOP. It is a sinking ship and the rats are jumping out. And of course, over the weekend, Nancy rejected Trump's offer, saying that it is insufficient. This is, of course, to be the 1.8 trillion. Of course, Nancy's not interested in a deal. She has the president in a corner. The Democrats are winning big. She has no incentive whatsoever to pass a deal. And the president isn't smart enough, at least for now, to go out to the public and say, look, I want to give you $2,000 check each. Nancy doesn't want that because she thinks that will help me win the elections, therefore turning the public opinion against Nancy. We will see if he's going to do that or not. And if he does, it will have potential implications in the market. But of course, we heard in the weekend that both parties are not interested, and they threw cold water right away on any deal happening before the election. The Republicans don't want to risk their reputation by passing an exuberant spending bill, and now the president, like I said, fell into Nancy's trap. Now, I'm not a fan of Nancy at all, but you have to admit that she knows how to play politics. She continued to drag the talks about the talks about the talks. For as long as she can, the president fell on the trap, fired the tweet announcing that he is the one withdrawing from the talks, therefore burying himself politically. And now the edges and the advantage shifted toward Nancy's side. And now the president has to face and battle not just Nancy, but his own party. And the situation is becoming a big, fat mess. A total nightmare for the president. And now let's move on to cover the charts analysis. Right away, starting with the S&P 500, here is a 15 minutes chart. Right away, you can see how resistance lines become support once they're broken. And right now, we've broken pretty much every resistance line in sight. And the sky is the limit for the SPY. You cannot be bearish, even if you do have a bias, against a chart behavior like this. So to find out where the sky is, we need to move to a daily chart. And here we go. The next resistance here is the upper limit of the breakdown candle at 356. But keep in mind, I don't like the action that we've done this week in the SPY. I think that the market is preparing for a Halloween trick, because all of these gaps that we've created on the way up, they create air pockets that will get hit at some point, and you will see a flush down in the chart. When will that happen? I have no clue. But you do know that we do have resistance at 356, and perhaps we can reach there before we hit an air pocket, and you see all these gaps waiting to be filled in the flush down scenario. And this would be the Halloween trick. On paper, the market is very, very bullish right now from a technical perspective. But from a trick perspective, that is a different story. I am very skeptical here, but I will not fight the market unless I see certain signals. We'll talk about these signals in a little bit. But for now, moving on to the Qs, 15 minutes chart. Right away, you can see how resistance turns into support, just like we discussed in the SPY. And the next near-term resistance here around 286. Breaking 286, gapping above 286 in the morning will mean that we will have to go all the way to the trend line again. So let's look at that from a daily perspective. And you can see right away the two scenarios here. Are we going to hit the trend line and then reverse from there, trending lower? This is a scenario that I talked about a few weeks ago, anticipating that the Qs would rally all the way to the trend line, get rejected, and trend lower thereafter. Or is it going to be a recapture of the trend? How do you answer that? Apple. We'll talk about Apple in a little bit. Be patient. But here is a weekly chart of the Qs. Right away, you can see that there is a potential crossing to the upside in the MACD. However, the bearish ABC pattern from a weekly perspective is still intact. So again, conflicting messages from the weekly chart. So what do you do about it? How do you know? Wait for it, the Apple chart. And I'm going to keep you waiting here in anticipation because I'm going to cover the dollar index before. Here we go, 15 minutes chart. You see the 93.50 as a very, very important level. And if you do remember, my strategy for this week was a straddle. I bought the TQQQs and I had puts on the TQQQs. And I told you by Monday, I will know right away which one I'm going to keep. And I closed my puts and kept my position in the TQQQs, the long position that is, because here's what happened. On Monday, we breached the support line and broke it. And we tried to retest it, to revisit it, and we got rejected from it. That was enough signal for me watching the dollar index to realize that we will have bullish activities in the market overall. Of course, we did have that big flush when we heard that the stimulus deal got rejected, and you see the dollar index spiked higher, and there was a lot of confusion, and of course a lot of people fell in that trap, shorting the market or going long the dollar index before you know what happened. The circus continues, and they keep dragging this game to prop the market up. But looking at the 15 minutes here for the dollar index, you see the loop between support and resistance for the 93.50 level. Extreme importance for that level. On Friday, we had a hard rejection. The dollar index tried so hard throughout the week to climb back the level of 93.50. But Friday's rejection was very extreme. And if you are looking from a technical perspective alone, the dollar index is looking extremely bearish right now. However, I'm smelling a trick right here. I don't know if my instincts are right or not, but I smell a trap making everybody comfortable that the market would rally and the sky's the limit and the dollar index will collapse completely before you see a surprise reversal. Because remember, we are still bounded by the news cycle. And anything could change in any given moment. I'm smelling a trick, but yet again, I will not fight the market. Switching to a daily chart for the dollar index. Remember what we said. If we don't pop higher and we continue to linger around on support, the 93.50, we will give way to the bear flag scenario flushing down. And you saw that happen exactly on Friday. Now, switching to the weekly chart, you can see right away that the bullish ABC pattern is still intact, but it is starting to look very weak right now. And breaking the 93 level, which happens to be the lower end of the break up candle, will mean that the ABC pattern went down the toilet. Now, let's talk about the IWM because it was the outperformer throughout the week. Where do we see the IWM from a weekly perspective? The resistance here is the 167, the gap, obviously. I do see technology and the Qs outperforming next week while the IWM takes a retreat. So perhaps we hit the 167 and we trend lower from there, or at least consolidate for a little while. Moving on to the VIX. From a daily perspective, the good news is that the VIX yet again held the 24.8 or let's say the 25 support. The bad news from a weekly perspective is that we do have a potential crossing to the negative side, meaning a downtrend in the VIX. That is yet remain to be seen. But here is the thing. If the market is already pricing a Biden's win, then that removes the uncertainty and the volatility of the election right away. The market might find comfort in that kind of thinking for the short term, and it certainly did this week. But remember, we still have more than 20 days to go for the elections. Anything can change. Therefore, I would not short the VIX. I will actually take opportunity if I see it go lower to accumulate positions, because any surprise, read the elections here, will force massive short covering in the VIX. We know that the VIX is being shorted heavily. And now, moving on to the two most important charts of the week, the upcoming week, Apple and Tesla. Starting with Apple, it's all about the 120. This is from a daily perspective. The 120 is a critical level for Apple. Breaking above it sustaining gains above it will be very bullish for the name and for the market overall. Reaching 120, getting rejected, and reversing from 120 will mean bad news for the overall market. As Apple goes, so will the market. Again, I bought the 120 calls on Friday morning. I will wait till 120, or as we get closer to 120, perhaps on Monday when we open, or Tuesday, I will take my gains and I will wait for a sign and a signal for a reversal. If that reversal doesn't happen and we see Apple trading comfortably above 120, you know exactly what that means. And here is a weekly look for Apple just to illustrate the conflict between the bull and the bear outlook. The bull outlook from a weekly chart perspective looks at the MACD and it sees a potential curling and crossing to the positive territory, meaning a new positive trend for Apple. Here is a weekly chart of the SPY just to illustrate that. Crossing the blue line average, creating red impressions in the histogram, means the end of a trend. Climbing back, crossing the blue line average to the upside, creating green impressions in the histogram, means the recapture or the creation of a new trend. Now back to Apple weekly chart. The bull thesis says we're about to cross higher in the MACD, creating a new trend, positive trend. However, the bear outlook remains, look, this is a bear flag formation that could trend higher, of course. However, a continuation of the primary leg down will take place at some point. Now, moving on to Tesla. 15 minutes chart, right away you see the level of 425.36, the gap holding again. This is very bullish behavior for Tesla chart from a 15 minutes perspective. Now, moving to a weekly perspective, and here is the number you need to watch for, 453. I am anticipating a move to the 453 and then a rejection for Tesla shares, which will lead the name to trend lower from that point on. So again, 120 for Apple, 453 for Tesla. These are the two levels you need to watch. If we reach these levels, get rejected, trend lower, that is your sign that the market will reverse and we will hit an air pocket and flush down. Reaching these levels and breaking from them, breaking to the upside, even if there is a little bit of struggle in the short term, will mean bullish, very bullish outlook for the markets overall, specifically the Nasdaq. And now let's move on to conclude the video. The market, as you might have heard, is pricing a Biden's win. Going into the week, of course, we were anticipating the president's return from the hospital, and the stock market reacted very positively on that news. However, there was a divorce between the market and Trump right after he got released and did his erratic behavior of removing the mask and downplaying COVID and pulling out a stimulus deal, sinking further in the polls. You saw the knee-jerk reaction from the market, flushing down after we found out we're not going to have a stimulus deal. Yet the market is in a mentality to find optimism in the darkest places. And the market decided, look, even if we don't have a stimulus, the president is pretty much a sinking ship right now, and we should prepare ourselves for a Biden's victory. Now, what is the wall of worry for the market right now? Number one, the stimulus. Number two, the contested election. Number three, corporate earnings. Now, if we know for sure that Biden will win, well, that removes the contested election scenario out of the wall of the worry. Furthermore, it means that yes, we're not going to have a stimulus in the short term, or maybe the president will cave and agree to the big stimulus deal from Nancy. But even if he doesn't, a blue wave sweep in the elections means a bigger stimulus deal to come. Instead of giving people $1,200, perhaps the Democrats will give everybody $2,000, and that is good for the market. The market expects and want more from the Fed, more from the federal government. And this is why the market decided to reverse from the losses right after the no stimulus deal and trade higher. And if you do remember, we made a scenario analysis about Trump's outlook after he got COVID. And we said, if he comes out and this is the most likely scenario, more reckless about COVID, the reopening stocks will benefit significantly. You saw that happen this week. Furthermore, if he is politically weakened, that will give a way to the scenario of a Biden win, which is, after the election, would be a massive sell-off due to the increase in capital gains taxes and corporate taxes. But in the short term, removing the wall of worry, the stimulus, and the contested elections is very bullish for the market. And here is what a Biden win means for the market in details. Number one, big oil benefits significantly. This is, of course, the short-term outlook. The market will have its time to digest a Biden's presidency. But for now, this week, right away, the market reverted to its saved data of how to behave if it is clear that Biden will win. Big oil benefit because big oil, biggest obstacle under Trump, was the excess supply. With Biden's green energy policies, you will see a suppression in the supply, at least in the domestic production. That is very good for Exxon, Chevron, and the big oil companies. Not so good for smaller ones that depend on fracking and smaller wells in the country. These will be closed and they will go bankrupt, but big oil will benefit, and you saw energy as an entire sector rallying significantly this week. And the second sector that would benefit from a Biden presidency is health insurers. And you saw names like United Health and the overall health care sector, including Big Pharma, rallying significantly this week because they know that Trump's plan of cutting drugs prices and the uncertainty regarding his healthcare plan will go off the table. And now they have to price in Biden's plan, which is a continuation of Obama's healthcare policy, which is favorable for health insurers and big pharma. You also saw small caps, the IWM and the IWN, the value sector, outperforming significantly this week, specifically right after we heard the president's meltdown and his no-deal announcement on stimulus. This is again very evident, as you can see from this chart, that the transportation, small caps, and value outperformed technology and momentum this week because this is the autopilot move from the market to the Biden presidency playbook. In the short term, this is how the market will behave. In the long term, it will start to factor in corporate taxes and capital gains taxes. But for now, continuing in the short-term playbook, you saw the Chinese yuan rising significantly on Friday. So did the euro. And that, of course, will favor materials such as gold and copper, all rallying significantly this week, specifically right after the market decided that Biden will win the presidency. Now, which sectors are not going to do very well under this playbook? Number one, large caps and momentum stocks, including big tech. You saw the big tech lagged the market throughout the week. However, it made a comeback on Friday, and that could carry an important message, very confusing but important message, that perhaps the market went a little ahead of itself in assuming a Biden's presidency. Likewise, the Biden playbook is not good for big banks. And you saw big banks and financials in general lagging the market just by a little bit during the week. We talked about the US dollar. The moment the market realizes that Biden will win, it will price out all the tariffs and the conflicts with China. The yuan rises and the US dollar declines. Furthermore, and this is more in the long outlook in the Biden's playbook, higher taxes equal lower multiples for stocks. So let's conclude by combing through all this information, all the confusion. The market was optimistic that Trump will make a comeback, will pass a stimulus, and everything will be perfectly normal. After he came out from the hospital, rejected the stimulus, and started acting very erratically, the market sold off immediately. Then the market figured out a source of optimism in the blue wave scenario. saying, look, a Biden presidency in the short term will not be bad for oil stocks. It will actually be bad for the dollar, which means good news for basic materials and good news for small caps and value names. Furthermore, a guaranteed win by Biden removes the uncertainty and gives way for even a bigger stimulus. So let's rally and forget about Trump and the lack of stimulus for now. Yet the action on Friday was a little worrisome if you're assuming this scenario, because I think that the President, Trump that is, has another trick up his sleeve. And I think it is too early to assume the blue wave scenario. We still have time to go. Yes, Biden has the edge, and the market showed that clearly, but there is still room for big surprises and tricks to happen. And I think that the market will play this yo-yo game back and forth along with the flow of news. To remain sane during this upcoming week, this is my outlook. I think that the technology sector, the Qs, will outperform and catch up to small caps, transportation, and the Dow Jones, while these names, of course, take a retreat. We do have Apple's event. We do have the Prime Day event for Amazon. I expect an outperformance for the NASDAQ and the tech sector. What you need to look for, however, is Apple 120, Tesla 453. Forget about the dollar this week. Forget about all the other indicators. Look for Apple 120, Tesla 453. If both names break above these levels decisively, it means massive rally and bullish outlook for the markets. If we hit them, get rejected, and reverse, you know that the market will decline. That way you don't have to worry about the stimulus or a Biden's win or a Trump win, whatever surprises the news will carry. You look this week for these levels and the technicals solely, and you will stay sane.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.